Hey, what's going on, everybody? This is Dan from Landshark Education. So we're going to discuss in this video, we're going to go over portfolio management, and then we're going to discuss learning to trade like in the stock market and how to basically structure a portfolio and to look at the stock market from a different perspective of just buying stocks and shares in the market. So whether you're new to trading, you're trying to figure out if you want to do this, we have some really good information on our YouTube channel. You can subscribe. You can also head over to our website. It's landsharkanalytics.com or longshortradio.com, and you can attend one of our free trading workshops that are in different cities across the United States, or you can also attend one of them online. So let's discuss trading in the stock market. We're going to go over a very, very short video discussing trading futures, options, and shares. So typically in the stock market, there's kind of a misconception that a lot of your only options are to invest in a company and buy shares of their stock. So the stock market used to be something where companies went to raise capital and to grow their businesses. So over the years with technology, it's kind of morphed and developed into something entirely different. So where it used to be where we were buying companies like Warren Buffett did back in the day and letting the capital grow, it's really not like that anymore. Now, obviously, some investors trade like that, but we're really just kind of talking to the at-home retail self-directed investor. So one of the problems, and there's kind of four that we'll highlight here, are picking home run style stocks. So typically for people that are coming into the stock market, one of the mistakes they make, and again, everybody's learning, so there really are no kind of big mistakes, is the concept that you have to buy a stock and do research and hope that it goes higher. Right, this is the same concept that a lot of retail traders get mixed up on, and they may win on the trade, but they really just got lucky and don't understand why they won. Is I think a stock will go higher because I think their X product has done well. Right, there are a lot of factors to take place when you're trying to analyze a company. It takes a lot of work to do that. Right, there's a lot easier way to slice about in the markets, so we're going to discuss that a little bit. So the second thing we'll go through is the concept of going all in. I'm going to use an example of recent and what's almost inspired this video this afternoon. And this other concept is some traders or investors think they have to put their entire portfolio into one position. The other thing that also seems to be pretty prevalent is people think they need to have 20 or 30 different stocks and sectors in their portfolio at all times. Right? So I personally are almost cash in my brokerage accounts at 90% of the time. There's probably 10% of the time where I actually have a position on in options or futures. The other 90% of the time is just cash waiting to put it to work. There's no really buying and holding in the market. So the third problem is there's zero hedging taking place in retail trading accounts or retail investments. So what I mean by that is there's no concept of, okay, if I want to be long, we're going to use oil as our example in this video because right now oil is trading at generational lows. A lot of people think it's bottom and they want to get long. What I mean is there's zero hedging, and we're going to discuss this with some of the ideas here. So let's say you're long an oil stock, right? Let's say, for example, we'll use the premium example, Chevron gas stations, and you're long your favorite stock, which is Chevron, and you really think this is going higher. But short term, you're taking a loss, right? A negative loss, unfortunately, on this stock position, right? You can actually hedge this position out with crude oil futures, which are a pretty basic and straightforward product once you understand what they are, which we're going to give you some live examples in this video and show you actually how to do that. So number three is using the wrong products. So this is probably the most important one, and the problem we see a lot, and I've worked with students, and we've worked with students across different countries, is using the wrong products to trade and to express your idea in the market. Right? Again, we're going to use the oil example in this kind of slides and go through a few ideas. Is most investors trade the wrong products. Right? What I mean by that is that they either have too little capital, so they gravitate towards penny stocks, because they believe the only way they can put to work their capital is to buy a quote-unquote cheaply priced stock and flip it for higher. That's just not true, right? You can use futures, you can use equity options to express the same trading idea and actually outlay less capital, right? So this is probably my most important kind of a concept I hold near and dear, and a concept that I talk about in all of our Shark Sessions workshops is make sure you don't paint yourself into a corner and just trade penny stocks, right? If you have capital, if you're starting in the market and you're trying to figure out where to put your money to work, look at futures, look at options. Sure, it may take a little bit more time, but I assure you, in my opinion, I think there's a lot more leverage and flexibility for self-directed investors in those particular markets. Again, it's not just about being the typical what we've been taught to do all our lives is picking a good stock, right? The stock market, the capital markets are so much more than just picking good stocks, right? And I think that has to do a lot with the media portrayal of having you think, look, you've got to do this, this, and this. It's just not true. So we got a fancy graph that's supposed to go here. You know, a lot of shows like CNBC and people like to talk about a lot of graphs, right? We're really straightforward, no fluff, no BS, just giving you the kind of truth to actually go into the markets and start making money. So what's the solution? So come to a Shark Sessions workshop, right? We hold these workshops. They're live in all of our different campuses across the country. You can also attend them online, right? So that's a shameless plug, but seriously, we'll actually cover 3 realistic ideas that you can start doing now as a retail investor to start trading in the markets. So this is kind of a cool picture of our office in Scottsdale. If you ever come out to one of our Shark Sessions classes, we have a putting green right outside our office. We can look at that if you come into town. So what are the 3 ideas that most investors kind of lack, and what do we use in the market to express our ideas? So number 1 would be shares as calls, right? So what this means is, instead of buying call options on a stock, let's say you have a stock that's a quote-unquote cheap price, you want to buy a small position for your entire portfolio and hold that position and almost think of it as a call option, right? Whereas call options, number 2, which we'll get to in a second, these expire because of time value. These shares will never expire, right? This is a way to express your trading idea and not have to worry about time decay in options. So number 2 is call options, right? If you think something is going higher, leverage your capital, express your idea, right? We'll discuss this just recently in one of our Shark Sessions workshop. We used this idea, again, on oil. Oil was breaking out off of the lows. It's very, very expensive to go and buy shares of a $90 stock like Chevron, right? You can only buy so many shares at $90 to get a quality return. So what's the alternative as an investor? Call options. Call options will allow you to capture a larger upside move for a shorter amount of capital, or smaller amount of capital rather, that you outlay into the market. Now, obviously, you have a defined risk with this as well. So if we buy a call option like we did for 70 cents, which is actually $70, the max we were going to lose 2 weeks ago in this trade was $70 per contract. I can live with a $70 loss. It's very, very tough to sit on a $700 or even a $7,000 loss, right? So again, the concept with this, which we'll give you an example, is putting a little bit of capital out to express the idea that something will go higher. Number 3, and probably something I hold kind of near and dear, is futures trading. So futures trading is probably the most underrated, in my opinion, product for self-directed retail traders in the market. Now, what you won't see on YouTube, what you won't see online from education companies, from other educators, is not a lot of people will talk about futures trading, right? This goes back to slide number 1 of what we see on TV with Jim Cramer, CNBC, and stock picking gurus, right? The old concept of you think you're going to find a stock just like the Wolf of Wall Street did, and you're going to put one trade and it's going to make you rich, does not exist, right? It is a unicorn fantasy that a lot of us have been ingrained to think. It's one of the reasons a lot of people just don't like Wall Street or don't like capital markets to begin with, right? Futures trading is a really, really good product because it allows you to leverage your capital, right? You can trade in a shorter time frame period. So whereas you would buy a stock, a futures trade typically will last, for some of us, 1, 2, 3, maybe 15 minutes, right? We can put money into the market, we can extract money from the market, and our trading day is done, right? For those of you who don't have 5 years to find a stock to buy and hold to make money, if you are trying to make money for a down payment or a vacation, whatever it is, I think futures trading in general is a very, very good source of income style trading. And what I mean by that, to define it, is that you can get into a trade, get out of it, and not have to hold something like I mentioned for a duration of time. So these are the three ideas. We're going to go into some actual examples with some live trades next. So let's go to the next slide. So the first one is shares as calls. What do I mean by this? Let's go into some examples. So shares as calls is pretty simple. You want to buy a low price share of a stock and hold them for a long period of time. I'm going to give you an example. I'm going to go to a recent trade which almost inspired this entire video of a stock by the name of EXXI. So I personally do not really ever trade stock shares anymore in my trading career, right? I kind of refuse to do it, but I'll give you an example here with this stock named EXXI, right? All I know is they're an oil and gas company, right? They have some fundamentals behind it, but I'll discuss a certain idea. This had a large rally when oil rallied a few weeks ago, from 30 cents to $1.50, right? Most recently on this particular stock, yesterday at the time of making this video, I bought shares about 53 cents of this. Now, for my portfolio, and I'll pull up the screenshot of this here, when I bought these shares on this particular trade, I put about $1,500, give or take, in this particular trade. Right? It was actually about a $1,000 entry. I made about $500 on this particular trade. So my cost of capital for this trade was about $1,000. Right? Now, for my portfolio, as I structure it, right, I would have been willing to allow this to go to zero. As funny as that may sound, I'll explain the concept in a second, because I believe that this stock would have been trading at $3, $4, $5, $6 in a year, right, when oil potentially bounces to new highs. Now, I didn't actually hold the trade. What I did was made it a one-day trade, right? The stock went 53 cents to 83. I covered the position, right, made a quick $500. But the concept is, with this particular trade setup, and let me get out of this picture here real quickly, is, again, if you think oil is going higher, right, and you want to leverage your capital and maximize your potential return, you can buy a stock that is quote-unquote cheaply priced or undervalued and hold that stock. The alternative is buying call options on a stock like that. Right? The issue with call options on that is those call options have a time expiration. Right? Maybe $1,000 is too big for your portfolio. I'm giving you an example. You have to size it according to what your risk is. Maybe $200 of this stock is plenty enough risk for you where you could say, look, if this goes to zero, it's not going to hurt me. Right? I can still pay my bills, do whatever I need to do. But if that stock triples, doubles, quadruples, whatever you want to call it in price, right, you can potentially increase your capital. Right, this is one concept, right? And I think this is a concept a lot of people use in their portfolios. I like to use it at probably about a 10% position in my portfolio. I don't like to use it at all, or not all, but all the time rather. But there are certain situations with oil and the lows that I want to use it. So what do you want to do? You want to find a sector, right? Either pick an energy sector, a metals, or telecom market. Then you want to structure the trade, right? Figure out how much capital for your account, your entire portfolio makes sense. Again, $1,000 might be too little for you. It might be too big. It all depends on your portfolio. So the second option is call options, right? So the idea here is to buy long-dated 60, 90, or 120-day call options, right? You don't have to go out and buy tens of thousands of dollars of call options to make the trade. Right, you can go out and spend $200 or $300 or $400 on call options, right, and speculate. I'll give you an example on oil that the price will rise. Right. Again, there are different strategies to go with this on this. You can add size on it to trade it, but the idea is not to actually express a call option. The idea is to buy the call option for a little and sell it to somebody else without actually exercising the call option. Right, this allows you to get into a trade with a low cost of capital and still allows you to put risk on the table. Right, so if you think some bio stock is going to be going higher, but you don't want to throw out $5,000 to trade that idea, you can go buy a call option for less and still have some quote-unquote skin in the game. So what do you want to do? You want to find the stock you want to trade, You want to chart the trade, which is probably more important than anything else. Figure out where is your exit price, and then you want to structure the trade. What strike call option and what time duration call option you need. So futures. So let's go over futures real quickly, and I'm going to discuss kind of combo here with futures and call options. Right. So the futures is a low cost of capital. They're short duration trades. If you don't want to trade Apple, you can trade the indice. If you don't want to trade GLD ETF, you can trade the metals, and so on and so on. Right. Low cost of capital to trade them. You don't have to have a watch list. You don't have to search for home run stocks. And last, there's quick trades for income, right? Be done beyond with your work or business. So let's actually go over an example, one of the examples that inspired this video. So the example is on stock EXXI, which I just showed you. I'm going to go step by step on this. So this particular trade that I made was kind of energy driven, right? The energy market has been getting clobbered. I don't think anybody, right, whether you want to call themselves professionals or hedge fund managers, whatever it is, I don't think people will debate the energy markets have been clobbered, right? So what's a way to take advantage of it, right? I personally took a small speculative position, about $1,000. When it was at 53, the target was 150. I covered the trade early. Again, this would be an example of where I could buy the trade, not really worry about it, and let it just go higher. If it gets there, great. Right? The idea is to hold the position, which I didn't do, but that's the concept with this. Right? Option 3, which I could have done, is trade around the position. What I mean by this is, if the position goes against me, for any reason, I can trade WTI crude oil futures. Right? So let's say, for example, I took a $500 loss, and I said, you know what, I don't want to have an unrealized loss. Right? If I had my portfolio, I go to the futures market and quickly scalp out crude trades and kind of replace the loss. Right? This is one of the reasons I love futures when you're into the stock market and trading your portfolio. Right? I'll go over the example here, and I'm going to cover a trade from one of our instructors that was pretty recent at UWTI. So UWTI is an energy ETF for oil. This thing was trading very, very cheaply. This is a typical strategy a lot of new traders will use. Right? Not new, but just traders in general, rather than rephrase that. So he bought this position, and it was on its lows about $1.30 a contract. It was trading at $2.20. So he used leverage, a lot of shares, right, to make about a $5,000 trade with oil bouncing off of the lows. Right? He believed oil was going higher, so he also put a core position. We would call this core in his portfolio. Right? This would also be the same concept as number 1, is shares as call options. Right? So the idea here is I can hold a core position. If it went against him, right, what he could do is come to the futures market and start hedging against the position. Right? Another example that would be, this is from another instructor I'll go through here, is like on Netflix. Right? These are long call option positions you're seeing on your screen. Right? Some small wins here and a nice little win on Netflix. If for any reason one of these trades went against him on long call options, he could then come to the S&P 500 Emini Futures markets, right, and begin hedging his positions against us. Right? This allows you to sustain a short-term loss if you believe the position is going higher. Right? That's why I'm a really, really big fan of the Emini Futures markets, because you're allowed, or rather, you can hedge with the Emini Futures. Right? So the last one here is long call options. Right? You think a stock is going higher for whatever reason, you want to buy a dated call option. Right? And again, if the trade goes against you, if you have a short-term loss, let's say on Chevron Exxon, right? And it's coming against you on a call option. You can trade around that position. You should trade around it using WTI crude oil futures. Same thing if we're long Apple calls and it goes against us, we can short-term trade or finance that trade with E-mini S&P. So that's a short lesson on trading in the market, 3 different ideas to get you started on structuring a portfolio and also expressing your trading ideas. Again, if you have a trade idea, specifically like EXXI. Again, I don't think it's something that you want to go in, which we already took this trade, go in and put your entire portfolio into long EXXI. Again, for me, I put a small position in that I could live with if I lost a position. But then again, I'm trading other oil names also because I do think oil will trade higher. So there's just multiple ways to express your idea. So if you want to learn more, you can head over to our instructors trading blog. It's free. You can register on landsharkanalytics.com. You can also attend a free Shark Sessions workshop. We have these workshops live at a few of our different campuses as well as online. You can also visit longshortradio.com. We have a weekly radio show that comes out on Tuesdays. Again, that's longshortradio.com. You can also send in comments and requests if you want to hear a certain topic discussed on the radio show.